Venture into the complex landscape of finance, a world where terms such as credit default swaps, or CDS for short, are not only common vernacular, but are also the talk of the town. Imagine a bustling stock market, where seasoned investors and rookies alike are navigating through a maze of financial jargon, trying to make informed decisions that will yield them the best results. One such term that often pops up is credit swaps. But what does it mean? Let's break it down with a simple analogy. Picture this. You've loaned a friend a hefty sum, a substantial amount that could leave a dent in your bank account. You trust your friend, but there's a nagging worry that lingers at the back of your mind, the worry that they might not pay you back. The uncertainty is not just about their ability to pay you back, but also the timing. What if they delay? What if they default? The thought sends shivers down your spine. The worry keeps you awake at night. To ease your anxiety, to allow yourself to breathe a little easier, you decide to take a step that many investors often take. You decide to take out an insurance policy on the loan. Now, this insurance policy isn't like the typical ones. It's different, it's unique, it's innovative. It's a simplistic way of understanding a credit default swap, a term that can sound intimidating but is in fact a safety net that investors weave to protect themselves from market uncertainties. So what exactly is a credit default swap? Simply put, it's a type of financial derivative, a contract if you will. The contract that empowers an investor to swap or transfer their credit risk with that of another investor. It allows them to hedge their bets, to play it safe in the volatile world of finance. It's a key tool in risk management, an ace up the sleeve for any sagacious investor. This, in essence, is the intriguing world of credit default swaps. Now, it's not a one-size-fits-all kind of deal. There are numerous types of credit default swaps, each possessing its distinct attributes and uses. These varieties of credit default swaps have been developed to address the various needs of investors, hedgers, and speculators. The intricacies of each kind warrant a closer examination to appreciate unique features and the peculiar ways in which they operate. First up, we delve into the world of the single-name CDS. This type is specifically linked to one solitary issuer of debt. Essentially, it's akin to purchasing an insurance policy on a single loan. The concept is fairly simple. You are insulating yourself against the possibility that the issuer might default on their debt obligations. You, as the buyer of the CDS, stand to receive compensation if such an unfortunate event were to occur. The single-name CDS serves as a protective shield, cushioning you from the potentially damaging effects of a default. We then transition to the basket CDS. This form of CDS takes a more diversified approach. Imagine a basket brimming with a variety of fruits. Each fruit represents a different reference entity. This type of CDS functions in a similar manner. Instead of pinning your hopes on a single issuer, you're spreading your risk across multiple issuers. The basket holds an assortment of reference entities, thereby diversifying the risk. This approach minimizes the impact if one issuer defaults, spreading the potential loss across the basket. Moving along, we come across the index CDS. This version bears a resemblance to a mutual fund. It's a diverse assortment of single-name CDS derived from a wide range of issuers. This amalgamation forms an index. The risk distribution is even more extensive in this case, as it encapsulates a broad market segment. With the index CDS, your investment is spread across a wide array of issuers. This type of CDS can be an effective tool to hedge or to speculate on the overall direction of the market. Finally, we introduce the total return swap. In this particular type, the buyer receives the entirety of the return from an asset and pays the seller a predetermined rate. It's a financial transaction akin to leasing a property. The lessee pays the lesser an agreed-upon sum and in return gets to enjoy the property. Last but not least, there's the total return swap. In this type, the buyer receives the total return from an asset and pays the seller a predetermined rate. It's like renting out a property. The renter pays the owner an agreed-upon amount and in return gets to enjoy the property. To wrap it all up, credit default swaps are financial tools that investors use to manage their credit risk. These instruments are widely used in the realm of finance by both individual investors and large financial institutions. The world of finance is often seen as a labyrinth, complex and intimidating, but with the right tools, like credit default swaps, this labyrinth becomes a lot more navigable. There are various types of credit default swaps, each catering to different investment strategies and risk tolerance levels. The single-name CDS is a type of swap where the underlying asset is linked to one entity. On the other hand, basket CDS involves a group of entities, increasing diversification and spreading the risk. Index CDS are linked to a market index, allowing investors to hedge against market-wide risks. The last type, total return swaps, allows an investor to swap the total return of an asset for a fixed interest rate, providing a hedge against fluctuations in asset values. Each of these types is a unique tool, offering different strategies to manage and hedge risk. The application of these instruments may seem complex, but once understood, they can become powerful allies in the unforgiving world of finance. So whether you're an investor looking to manage credit risk in your portfolio or a financial institution seeking to mitigate potential defaults, credit default swaps offer a wide array of solutions. So the next time you're navigating the labyrinth of finance, remember, credit default swaps not some formidable beast. They're just clever tools designed to manage risk, and now you know exactly how they work.